Hello, everyone, and welcome. Thank you so much for taking time out of your busy schedules to join us today. Today is the launch episode of our webinar series called Exchange with Lula, where we're going to share industry insights, give some information about our product, and it's already tailored at the SME South African market. We are planning to run a webinar every Wednesday at 11 o'clock. So every Wednesday at 11 to 12. The topics are going to vary. We're going to cover a whole lot of different things. We're going to share our next week's topic later today. Please stay tuned for us. On today's webinar, I've got two exciting people who are going to be speaking, trailblazers at Lula. So both of them are we're all sitting in our Cape Town head office at the moment. We're all in the same office in different rooms. First, we are going to introduce Garth. He has been with the business for 6 years, which is actually more than half the time the business has been around. So there is no one better to give us insights into the SME landscape. So thank you for being with us, Garth. Garth is our Chief Risk Officer. So what does that actually mean? Garth is in charge of analyzing our internal as well as external market factors, so he is in charge of understanding the state of the economy, understanding our business, and making sure that we lend responsibly. So it's really great for our customers and it's very great for our business. Then we're going to be handing over to Thomas. Thomas is our Chief Growth Officer at the moment. He joined our business at a very interesting time, just before the pandemic hit. He's had lots of titles at Lula. He has been our Head of Product. He has been our Chief Operations Officer, and most recently, he is now our Chief Growth Officer. He's going to take us through our product, give us a demo, and that is going to be the format today. So Garth's going to start giving us some industry insights, speaking about the SME, the economy. Then we're going to hand over to Thomas, and then we're going to do a Q&A section. So please stay until the end so you guys can ask any questions that you would like to have answered. They're available to you. So without further ado, I'm going to hand over to Garth to kick us off.
Awesome. Thanks for the intro, Lee. And hi, everyone. As Lee said, I'm going to give you a bit of an overview of the SME market. We've obviously got access to quite a fair bit of data from our clients, but we've been through a bit of a process to assess the state of the market. And what we find is there's a lot of SME data, well, there's very little SME data out there that other people have. So it's very rare to see a view as an SME owner of what the market's doing. So effectively what we're going to do is tell you what the market's doing, what we've seen over the last 12 months, and maybe a bit of an expectation of what we anticipate going forward. So this is a bit of an overview here. So what we did an analysis to assess the current state of the economy for SMEs. So just bear with me 1 sec. I just need to move something around here. So we looked at macroeconomic trends, we looked at bureau data, we looked at industry-specific performance, and obviously we've got a lot of clients, and we took feedback from them as well in terms of how things were performing. So our data has shown that over the last 12 months, SME turnover has dropped by about 50%, which is really significant. And when you put that into context, that SMEs in South Africa are the largest employer, employ more than 60% of our workforce. We see this as being a massive issue. This is obviously, as the data will show as I progress, a big concern for the economy. We looked at Experian data. So Experian is one of the world's bigger top 3 bureaus, credit bureaus. So they've got access to a vast amount of data. And they've said we've seen kind of rising defaults, which have been linked to longer debtor days, which is effectively how long it takes your clients to pay you. We've looked at their FAS groups, which is their financial affluence segmentation. So the more affluent in society, 1 to 3, which are largely business owners. And they've been particularly vulnerable to interest rate fluctuations due to high levels of gearing. So we'll talk to that as well. Their default index did not improve in 2024. So things were very, very challenging for them. Then the biggest challenges, as we've seen, have come from high interest rates, inflation, and general economic stagnation across industries. So we'll dig into that a little bit. And obviously, despite the recent interest rates cuts, these interest rates have been high for a really long time, and they've been at the highest levels in 15 years. So that's obviously driven default as well. So we've also seen a decrease in formal employment. So not just unemployment, but actually people employed. So they're slightly different in terms of the definitions. And that's obviously further pressured business revenues as people can't spend money if they're unemployed. And it also delays customer payments, as we've seen. So our turnover affordability index has come down by about 60%. So we're obviously in the business, we lend money to SMEs for various reasons or various purposes. And affordability is something we take quite seriously because we're very focused on responsible lending. So we've seen big reductions in affordability across renewables in particular. So a lot of people implementing solar, that died down, and we'll have a look at that. And then agricultural disruptions as well. So we've seen trouble in that sort of area as well. So we've seen early signs of recovery we'll get onto that. But there's a lot of uncertainty in the market, and I think that's something that people are grappling with at the moment.
Thanks, Garth. Sorry to interrupt your flow for 1 second. I see some people have their hands up. Could you guys post the questions in the chat, or we can do the Q&A at the end, whatever works best. Thanks.
Cool. Okay, great. So just a bit of the landscape now for 2024. There were a few positives and a few negatives. So obviously, I think SMEs in South Africa are pretty resilient, and we've seen that consistently right through COVID and up until this point. But load shedding, for one, suspended in March, really came with some positive sentiment for business. Load shedding really was disruptive to small businesses. And barring one weekend in January, we haven't had load shedding. The GNU, the Government of National Unity, was really positive in terms of external and internal sentiment towards South Africa. And I think the transition there gave a lot of people that positive sentiment, which drives business confidence and which drives investment in the economy. So that was positive. And then the interest rates decreasing in September, November, and then January again by 25 basis points. So those are all signs we see as tailwinds and things that should start filtering into the economy as improvements. The negatives, though, are that interest rates have been high for a super long time. We've seen high inflation, which put significant pressure on these consumers and businesses. The inflation and the interest rates means disposable income was a lot lower. And we've seen further increase in very high unemployment. We're obviously sitting as highest in the world in terms of unemployment, which is not great in terms of people spending with SMEs, and creates other challenges socially as well. And then logistics issues. We've seen Transnet continually struggling. Our ports are ranked in the bottom in the world, and a lot of government attention needs to be focused on getting that right and building efficiencies in those sort of areas, because that impacts everything for importers, exporters, just getting goods around the country. Really important for small businesses to be able to operate with infrastructure that works. Looking at the operating environment, the first chart shows the GDP. So over the last 3 years, we see it's always been sort of pretty erratic, but the overall trend in the last 3 years has been that we've seen a bit of growth. So in 2 years ago, we saw a bit of growth. That got a bit more tempered in 2023, and in 2024, over the course of the year, we saw very little growth. When they talk about recession, they talk about two consecutive quarters of negative growth. So we actually haven't seen 2 consecutive quarters of negative growth. And there was concern that this last quarter, which has just been released yesterday, was going to show negative growth, but it hasn't. So that's another positive, something to add to this analysis. But effectively, the economy growth has been very, very muted, and it's been limited to a couple of sectors, which we'll see on the next slide. But given that growth, the chart on the right then shows you, with GDP under pressure, what's actually happening to employment. And that's dropped by 2.7% over the course of the year. So that means people have lost their jobs who were previously working. And that's driven by SMEs not having enough money, obviously, to support those jobs. And it's pretty bad for obviously the country in terms of where we want to go in terms of increasing our employment levels. So yeah, so that's high level there. If we looked into the industries themselves and how they were performing, so agriculture specifically had a terrible period, and we can talk about that, but agriculture, just generally speaking, has faced droughts, they've faced floods, they've faced avian flu. So there's been a number of factors which have driven the poor performance of agriculture in Q3 last year. And finance is the one industry which has shown relative growth, but this is all relative. I mean, 0.3% growth is nothing to really write home about. So we can pretty much say everything else is either contracted or been pretty flat. So unless you're in the agriculture industry, you would have felt that as well. Then Experian, our credit bureau, actually gives a nice breakdown of whether conditions are improving or worsening. So this is Q2 to Q3. So you'll see construction and agriculture have been worsening for a couple of quarters. And most of our bigger industries have all been contracting or again in Q3 with very little growth across other sectors as well. So that just gives a bit of an overview there. So in just summary, to summarize that operating environment, our GDPs remain stagnant between Q3 and Q4. And then, sorry, that should be Q3. Oh, it is actually Q3 2023, so over the year with a 0.3% contraction in the last quarter. And then formal employment's decreased, as I mentioned, and we're seeing negative business conditions in Q3 2024. So just for context, Q3 2024, our last quarter was to September. So the October to December period are the numbers which are just coming out now. Then this is what is really important in terms of understanding the economy. So we'll see here that, as I mentioned, business owners in this segment have been really negatively impacted. So when interest rates were low, a lot of business owners and people in those higher income segments took on a lot of extra debt. So bought new cars, houses, etc. And that's in that where you see the dip really in the middle here. And as interest rates rose, those interest payments obviously became unmanageable, and they just increased and increased and increased. And they've been at this high level, which is the highest in 15 years, for a significant period. And ultimately, if rates are that high for that long, it really results in lower consumer spending, people spending money on repayments rather than growth. And that drives into SME turnover as well. We start to see SME turnover dropping because people are not spending on goods or services. So that creates a lot of pressure on those consumers, and that filters through into the SME market. So we do think there's a bit of a transmission lag. SME consumers feel at first. So you'll see those increasing rates over time, and at the end of 2023 and towards 2024. And there's a lag that SMEs start to feel. So SMEs only start to feel that impact potentially up to 12 months later. So that's what they were feeling over the course of last year. Sorry. So here, these are a couple of charts. So just to give you a bit of context, the orange line is quite an important one. So that's inflation. So interest rates and inflation tend to move in opposite directions to each other. So interest rates are increased as a response to inflation. So if inflation is too high, what government tries to do is to slow down spending to reduce inflation, and they do that by increasing interest rates, which makes it more expensive to borrow money. So those do tend to move in opposite directions. What we've seen, though, is inflation has been coming down since sort of middle of 2023, and the interest rates actually didn't come down quick enough, in our opinion, to address that. So businesses weren't earning the same sort of money as that inflation was dropping. They had to introduce sales and get rid of stock because of the low inflationary environment, but the interest rates are still high, so people's disposable income just kept putting pressure on them. So what we see there is our affordability index, which is a bit of a lagging indicator for SMEs in particular. That started dropping off quite significantly in March, April last year, where we started to see businesses feeling the pain of this lower consumer spending. And then the prime rate at the bottom is just effectively, sorry, just ignore the scale, but the prime rate kind of, the default index at the bottom is how defaults started increasing as those interest rates started increasing. So you see those kind of move in line with each other. So as higher interest rates resulted in higher defaults on a personal basis, and for SMEs, as we see over here. Then this is something more from a practical point of view for SMEs in South Africa. And I understand everyone's works in different industries. So it's difficult to kind of give a generalized view in a couple of slides. And each industry is slightly different. But generally speaking, your debtors days is how long it takes your debtors to pay you. And what we're seeing there is the numbers are the highest they've been since 2022. Which is just sort of post that COVID period. So there's been a lot of delays in clients paying paying you or paying your businesses, and that's caused a lot of problems. On the right hand side, what is interesting is SMEs versus the corporate market in general. So the 52.8 there you can see for the corporate, which ties in with the chart on the left. That's overall South African debtors days, but then SMEs in particular, which is really our target market, see a much bigger impact. I mean, you see that number in the 70s there, and it's got worse in the last couple of quarters. So there's been a massive delay that small businesses are feeling, and that's a symptom of the fact that small businesses don't have the same power as a large corporate. So unless you shop right or and you can dictate terms, small businesses can't often do that. So it puts a lot of pressure on them. And that's what we're seeing. These delayed payments, businesses under a lot of cash flow pressure because they've obviously got obligations of their own. And either they kick that can down the road or they face very real cash flow issues. So those are a couple of things we've been seeing there, and that's as a result of that contraction in the GDP, which is just filtering through the economy. So just a summary there, the high interest rates have negatively impacted business owners' ability to meet their obligations. The Experian Business Debt Index, the BDI, for these core business owners worsened 75% since 2022. That GDP contraction has resulted in delayed customer payments, with that sharp increase seen in Q3 last year, which is felt really more so by SMEs. And then we have, if I just go back a couple, you'll see there's a slight improvement there in that BDI, in that default index towards the end of last year, which indicates that things are improving. But in terms of context, it's been a tough 12 months for these small businesses. Then just the impact we've seen on some key industries here. So energy and renewables, obviously without load shedding, a lot of the businesses that went into solar and installations, etc., struggled where people decided they no longer needed solar. How long that'll last for obviously depends on the cost of electricity. People may change their mind and start installing power again, or solar options or other renewable options. But also, so and the cost, if the cost increases, but also obviously if load shedding returns. So got to see a long-term impact there. There is an argument to say that load shedding, the limited load shedding is also due to the lack of economic growth. So if industry isn't demanding much electricity, that's going to hold back in load shedding. So whether capacity is being added or not, I guess the jury's out there. In terms of agriculture, as I mentioned, droughts, floods, avian flu, and port congestion have all really negatively impacted the agriculture performance. And then restaurants, I think just in general, where interest rates are high, consumable, disposable income decreases, people feel poorer, and they can't borrow money, and that has a very direct and impact on restaurants. And it's the first industry to really be impacted by people with constrained income. Then looking at manufacturing, and as I said, we couldn't go through every industry, but we just try to pick some of the larger ones. But production declined in manufacturing. Again, logistical challenges impacted this. There was weak demand, and high energy costs obviously impact manufacturing production. So even though there hasn't been load shedding, there has been an increase in the cost of electricity. And obviously there's the ongoing impact of cheap imports. So on the construction side, construction directly impacted by interest rates as well, and you'll see a slight improvement in anticipation of lower interest rates in the last couple of quarters. And I think that's important to note. So interest rates and construction are very directly impacted because a lot of construction work is driven by people borrowing money through mortgages or buying houses, etc. So and doing renovations. So as interest rates come down, people feel they've got more money to spend, and that's that we're seeing there as well. In terms of our expectations, and this is just more of a summary, and there are a lot of moving parts here. Interest rates have come down, with inflation being within the government's targeted band. It was even slightly below that targeted band, but there are a lot of, whether they keep coming down, we do expect another interest rate cut in the first half of this year. Whether that happens, though, is driven largely by external factors as well. So inflation, for one, if inflation increases as a result of global events, tariffs, etc., then the result will be interest rates will not come down as quickly. And hopefully we don't see that trend reversing. But if the rand weakens, interest rates tend to go up to protect the rand as well. The lower interest rates will have a positive impact on specific industries like construction, renewables, and manufacturing, as I mentioned, which have directly influenced by interest rates because of the large spend and fixed capital. And then these same industries will benefit from government's commitment to boost infrastructure spend, which we saw in that SONA address earlier last month. So obviously the budget is going to be play a very big role in terms of understanding how these things change for small businesses. A budget that introduces new tax or VAT, for example, will be negative for SMEs, just from the perspective that it increases their costs. Very often they can't transfer those costs to consumers, which means inflation increases, which means interest rates don't come down. So I think that would be the negative impact from increased costs or increased taxes in a budget, whatever form those might take. Our stance has always been, if you want to make more money or more tax revenue, what you really need to be doing is reducing your tax rates, your corporate tax rates. If you reduce those, you actually encourage people to make more profits, and then you'll increase the tax in your coffers. So that's what we've obviously been encouraging. In terms of expectations, which is positive, IMF, Investec, PwC all see positive growth. I think the Bloomberg consensus is for 1.7% growth in 2025, which would be really positive. I think it's something, given the growth we've seen in the prior years, where we've seen good performance in 2022 and 2023, any positive growth is really, really important. Obviously, it depends on the industry specifically where that growth is seen, but overall it's positive for the country. So there are a lot of moving parts, a lot of the predictions and forecasts are driven by global factors. But in our opinion, we've kind of gone through the worst of it, all else being equal, and we should start to see an improving economy in the coming year. So I think that is the end of my presentation there, Lee.
Awesome. Thank you so much, Garth. Thank you for sharing all that, some really valuable insights, and really cool to get access to data that customers can't find anywhere else. So thank you for putting that together and sharing that with us. I actually just thought to open the floor to any questions on that presentation. If anyone has, now I see some people are posting in the chat. You can either post in the chat, we'll maybe get to the questions if we can now, or get to them at the end, or you can just unmute yourself. You can even put your video on if you're feeling brave, but you don't have to. I'll let people think for a moment to digest.
I would like to ask a question. My name's Jenny. If the budget is not approved next month, or if there's a delay in the budget, would that create a delay in government spending, for which so many companies, especially SMEs, are dependent on? We're a finance company ourselves, and we look to see if those grants come through, or if they're delayed, and very often they're delayed, but even more so, perhaps if there's a budget delay. Yeah, thank you.
Yeah, Jenny, thanks. Yeah, it's a very difficult one to answer. We haven't been in this sort of situation before, whether the budget gets frozen or the spending just continues until such time as a new budget gets agreed. My feeling is that it won't be delayed. I think there will be clarity on the 12th of March when the budget is announced. I don't think we can afford for it not to be. I think, I'd be guessing if I were to try and venture what that would mean. I think we'd have fairly big problems if we don't get a budget agreed by then. But it does sound like the negotiations are moving forward, and hopefully the prior negotiations are had before we actually have that. But I think the negative impact and the impact of uncertainty on business, I think, is the biggest problem. If we know what the budget is, we can work with it. If not, I think all of us are in a bit of a state of flux, and that's obviously what we're trying to avoid.
Thank you.
Thanks, Jenny. Anyone else with a question? Now's your time. Cool. If no one else has any questions right now, then we're going to hand over to Thomas. There will be a option to ask questions at the end, or you can just post in the chat and we can get back to you in the chat. Handing over to Thomas.
Hi there, folks. Seems like we got a really good turnout, so really glad so many of you could join us. And thanks, Garth, for those insights. I think, the consensus that we've heard is SMEs have really been struggling over the past year. I think the data that Garth has shared is pretty much saying, well, if you felt like you've had a tough year, and 2024 was just really a little bit too much sometimes, you're definitely not alone. So if you're feeling like your business wasn't kind of doing as well as you wanted it to, or that you're under severe pressure, yeah, you're definitely not alone. And kudos, if your business did phenomenally last year, you really did well, because all the numbers kind of show that it was a tough year. So what we want to jump onto now is a little bit more of, we get a lot of questions about, what does Lula do? What does your platform look like? All that sort of thing. And so we definitely want to share a little bit about, ourselves and what we offer. Feel free to ask questions. This is very much a product demonstration, a product plug. And so, yeah, feel free to drop questions in that chat. We'll address them afterwards. So I hope many of you are familiar with our webpage. If you're not, please bookmark it. But I'll give you a more important page to bookmark shortly. So Lula's been around for 10 years now. You know, we're almost a decade old. I believe in May will be the anniversary of our first disbursement. It's great to see that our first ever customer is actually still with us 10 years later, which is phenomenal, and hopefully a testament to kind of the quality of service and product we're trying to deliver. I hope most of you are aware by now that we've kind of expanded our offering. We do offer business funding. That's still the core of what we do and how we want to help businesses make cash flow. But we've expanded to business banking as well, very much targeted at SMEs. It's very early in our journey, but I thought, let me give you a little bit of a sense of how these things work together and what that looks like. So if you do need any information, what I would say is our website is a great resource for that. One of the key questions that we often get asked is, you know, am I eligible for funding? So just off the bat, I think important to highlight, you know, we're looking generally at businesses that have been around for a year or more, so not pure startups. We are looking for revenue generating businesses. So we generally express that in terms of either 500,000 Rand a year in terms of revenue, or 40,000 Rand a month. And we do fund South African businesses. So that doesn't mean that, you know, maybe the business owners are, you know, if they were foreign, for instance, that we wouldn't fund, but we fund South African owned businesses. So I think it's very, very important to understand that. And then a great tool, I think, for many of the customers that are looking for funding, a great way to kind of understand our product is through the calculator that we've got on site. This doesn't mean this is what it would cost you. We do issue quotes, and pricing can vary, but this gives you a little bit of a sense of what does the product look like. I think the thing that sets us apart is very much we've got a single flat fee. So for instance, if you had to look at you know, 100,000 Rand in funding, you can very easily see our payment plans. There is a cost, which is a single fee, and very important, that fee only applies to the outstanding capital. And so if you should settle you know, a little bit earlier, then you're not going to be paying for the facility or the full term of the loan. You only pay for as long as you're using those funds. And then you can also very easily see what does that look like over the 3, 6, 9, 12-month terms that we offer. And obviously, the faster you pay back, the lower the cost, but the longer you maybe get on a term, the smoother the cash flow outlay. And then another useful resource that I wanted to point you towards is it's very much under our resources section. We do have a knowledge base. So many of the questions that you might have about our different products can be answered here. And so you can find out, you know, what is a guarantee, for instance? How does the capital facility work? You know, how to change your debit order dates, etc. So that's all useful information that we get asked often. And then just in terms of a quick demonstration of the product, I'm just going to share a demo account here. What's important, I think, bookmark this page. We see a lot of customers that don't know how to get back here. So bookmark secure.lula.co.za if you're an existing customer. If you've got an application in with us and you're looking to track feedback on the state of your app, definitely bookmark this page and make sure you're able to return. I'm going to log in, so I'm not going to do an application now, but if anybody's got questions about the app process, we can look at that shortly. So on login, what's great is you'll see that we have added whatever list of products you might have. So for instance, you can have multiple bank accounts with Lula, which is a great feature where you're very easily able to add multiple bank accounts, something that kind of sets us apart. You're able to see your transactions. you're able to kind of go into detail and manage those transactions or get proof of payments, etc. Very typical type banking experience, but what we feel we've done is made it significantly easier for business owners to manage. We also offer multiple cards, so business owners can easily add up to 50 cards per bank account. There's a couple of rules around that. It's one physical and one virtual card per person. But other than that, you can do all of these things online. And it's also incredibly simple to share your details. Just note, Access Bank is our sponsor bank. So while we don't have our own banking license, we have partnered with them and leverage theirs in order to do that. So you can share your details, copy them. And something we get asked for a lot, and it strangely doesn't seem to be available on all platforms out there, is a bank account confirmation letter. So often when businesses need to submit this either for a tender or to get funding elsewhere, or purchase orders, or registering with another business to get terms, getting a bank confirmation letter is quite important, and you can do that straight out of the platform here. Very importantly is funding. So your banking and your funding experience has now been integrated. I've got an active facility here. Very important. You can see your advance number. So if you're calling into Lula or you need to speak to the service team, you can always cite this number and we'll be able to help you. And useful here is you're able to see all the details relating to your facility. You can get an overview. We're very naughty here. This one's in arrears. That will clear. So just to flag that this status just shows you the current status of your account. As soon as a payment settles, that gets updated. Pretty handy. You get a nice little summary of where your account's currently sitting. So while in this example, there's a 10,000 Rand facility, there's 8,333 Rand 34 available, and it shows you your outstanding capital amount. You are able to request a withdrawal up to the maximum of your facility, so whatever you are approved for, and you can submit withdrawal requests as you go. Importantly, we do generally assess every time a withdrawal's done. This is not an overdraft product. It's very much an advance on your future revenue. And so we do actually do ongoing assessments. Another important thing to understand, we really need transaction data to basically determine your affordability. As we've said, affordability is incredibly important to us. We need to lend responsibly or advance money responsibly. And so that's reliant on data. What's great is with our Lula bank account, we can do this on an ongoing basis. And so you're able to, we don't do it by default. You can opt in to link your Lula bank data into your facility, and we'll assess you against that. Or you can come in and you can upload PDF statements, etc. We've got on the roadmap a couple of interesting features coming where you'd be able to link some other bank accounts, for instance, your FNBs, your Standard Banks, your Ned Banks, etc., in the coming months. And then lastly, we often get asked about payment plans and what does my repayment schedule look like. So it's quite easy to keep track of your payment schedule within the application. And you can see that failed payment here. That's likely going to clear in a day or two, and that'll be updated soon. And you can get a full statement. So from the first withdrawal of capital to costs repaid and the fees, so capital repaid and fees repaid, with each debit order kind of bringing your balance due back down to zero. And you can download a PDF of that statement. Finally, you do get a full history of all the applications and advances you've made historically. So you can see that data, and you can, if you are an existing customer, it's quite easy to either open an additional bank account. This takes a few seconds. Literally, you just have to add the account type that you want, give it a name, and you've got a bank account open for you, an additional account. Or to submit a new funding application. And so you can do a withdrawal against your facility, as I said, that still needs to be assessed and approved, or you can submit a quote for one of our other products, like our fixed term advance type product. So that in a nutshell is the platform. I'm not going to go through payments today, but we do offer a range of payment types. So electronic fund transfers in and out are available. Real-time payments in and out are available. We do large value payments in South African rands, so 5 million and above. And we've got a fully featured card, which you can use domestically and internationally. Over the kind of coming weeks, we'll share more about the product and some demos from there. So that's a little bit of a taste and a flavor of what we are offering at the moment. And I think a key here is being able to, from a funding perspective, being able to view your funding product, to be able to manage it and understand where you are, to track your repayments, get statements as you need it. Those are generally the main use cases we have coming from our customers. So thank you.
Awesome.
That's you.
Awesome. Yes, now you can hear me. Thank you so much, Thomas, for that. It was actually a very cool tour. I really enjoyed that. We do have some questions that have come in. So if anyone else has anything to ask, Jenny's asking, is the max period 12 months? You can actually speak through my laptop.
Sure. Jenny, it is in terms of for first-time funded customers. We are looking at adding longer terms, and we do actually have some bespoke deals where customers have been provided with longer terms. But that's very much subject to kind of a history with Lula. Because it's an advance against future revenue, the longer you stretch that out, the harder it is to forecast what that affordability will look like. So in short, if you're applying for the first time, 12 months is the longest. If you do have a track record with Lula, we can actually offer longer terms, subject to a quote, subject to affordability.
Perfect. Thanks. I do see the other questions in the chat, but just relating to Thomas's demo, there's one other one from James. Thanks, Thomas. Does the business banking offering support API integration into payroll software?
So James, not at the moment. It is something that's on our radar. The way we do that at the moment is basically for export. So you are able to very easily export statements for the bank via CSV, and that's a very quick upload. In any kind of third-party software will be able to process that. We do have a roadmap of integrations within the wider ecosystem coming in the year ahead. So integrating with other bank accounts, integrating with accounting software is very high on our agenda, and that's something that we hope to share news about in the coming months. Payroll software, yes, it's something that we're investigating and looking at. One of the key challenges there aren't kind of these mega platforms used in the SME space. It's quite a fragmented space. So that's a key challenge for us to think through and solve.
Great. Thank you, Thomas. I don't see any other questions about Thomas's demo, but there was a question from James actually earlier, Garth, directed at you, said, thanks, Garth. What do you think the impact of the US withdrawing AGOA could be on the economy? Which industries do you think would feel it the most?
Yeah, thanks, James. Yeah, that AGOA is a big concern. I mean, effectively, that gives us preferential access to US markets, sort of at reduced or zero tariff. The industries, I think there would be defining the impact, I think is going to be difficult, but basically the US is our second biggest trading partner after China. So we do export a lot there, so we benefit a lot from not having those increased tariffs. What would happen is withdrawal, probably biggest impact on textile industry. The inputs into a lot of finished products come from South Africa. So textile, automotive, there's a lot of automotive parts, etc., which are made here, which benefit from AGOA. So those textile, automotive, and I would say the agricultural, so your fruit exports, fruit and vegetable exports, or from would be majorly impacted by any AGOA withdrawal. But I think what it might mean is that we end up our exporters are going to have to look at other markets. So whether that means increased exposure to China or to Europe as a result of those tariffs, I think would have to be considered. I mean, the impact of tariffs on Americans as well is if they keep importing, it's just going to push their inflation up. So I don't think that, I think it's pretty short-sighted. Just generally tariffs, I think, are. But that's more yeah, a discussion, a longer discussion, I guess. But I think, yeah, those three industries probably impacted most. I think most industries would feel it indirectly as well. I think we'd really be cutting off our nose to spite our face if we didn't do everything in our power to keep AGOA in play.
Cool. Thanks for that, Garth. Peter has a very interesting question. I'm just going to read it out so that everyone has view of it. If an industry is underperforming, what does that affect my business's chance of getting funding if I fall within that industry? So will my approval be dependent on the performance of the industry, or will it only be dependent on the performance of my business alone?
Yeah, I think it's a good question. So obviously we're conscious of industries, and industry plays a part in affordability within an assessment, but we look at every business on a case-by-case basis. So it's not, we're industry agnostic. We don't look at industry specifically. And if you have a good business in a challenging industry, you'll have every chance of success if you've got the right affordability. And yeah, I mean, affordability, as we mentioned a couple of times, is really important to us. It doesn't serve us or our clients to fund a business which can't afford funding or shouldn't be funded. Obviously, funding is the right thing if businesses are looking to grow and expand, and funding is not a great option if you've got your back up against the wall and you're just trying to pay a salary. You really want funding for growth, and that's where we really fill the gap in the market. But industry is a factor, but it's not. We fund some excellent businesses in some high risk industries, and I think that's what we pride ourselves on.
Great. Thanks, Garth. If anyone else has a question, now is the time to pop it in the chat or unmute yourself. Gonna give it a few seconds for people to... Oh, yes. Please ask away if anyone has their hand up.
Hi, my name is Ruben. I would like to ask here, as far as he said that he only funded the business wherein it's doing excellent. So for an example, let's say I've got a business since from 2017 and then it wasn't doing quite good. So let's say I got a contract from a mine, and then there's a specific equipment that they are looking for from me. And then I've got a contract with the mine in hand. So is it possible for you guys to help me with funding to get those equipment that they are looking for, using the contract that I have? Thank you.
Hi, Ruben. Yeah, no, it's a good question. So I think our target market, or our market in terms of the businesses we fund against cash flow. So we look at a business, we see what their cash flow has been, and we have minimum sort of turnover requirements in terms of 40,000 Rand per month turnover for the businesses we fund, which equates to around 500,000 Rand a year, which allows us to do an affordability assessment. So as I was saying, it's really important to us to make sure that we're not giving money to a business which which can't afford to repay. So in our automated assessment, that plays a very important part. I think in terms of different funding needs for different funding businesses, there's effectively, if I understand correctly, if you have a contract, but you don't have revenue or significant revenue at the moment, then other options there are equity funding, which you could try and source. So find an equity partner who's willing to invest in the business, or government grant funding as well, which is a good alternative for businesses which are early stage pre-profit, and looking for that sort of funding. So we don't fund at the moment based on future revenue expectations. We like to see that the businesses have been operating for 12 months and they've got some decent turnover to allow us to do that affordability assessment. But that's not to say there aren't alternative options available to you.
All right, thank you so much.
Pleasure.
Great. Thanks, Garth. And then just one last question before we wrap up. Someone is asking if they are wanting a 10,000 Rand loan, would they also have to have a 500,000 Rand turnover?
Yeah, so the 500,000 Rand turnover is our minimum, which is 40,000 Rand a month in terms of our ability to assess affordability accurately. We do have other products through partners, etc., and we fund them through Yoko, etc., through point of sale devices. So depending on the product you're applying for or where you're getting your funding, I guess there is an option to get a lower amount with less turnover. But as it stands now, for a normal term advance, your monthly turnover has to be at least 40,000, as I said, so we can assess your affordability accurately.
I see one last person has put their hand up. Yes.
Yes, that's me. Thank you for the presentation. Just a quick one. In terms of the turnover, does it have to be a consistent turnover monthly, or you look at the yearly turnover? I'm asking you, say you have maybe a quarterly turnover of so much, not necessarily on a monthly basis. Maybe you don't get a consistent turnover on a monthly basis, but the total of annual turnover amounts to the amount that you are looking at there. How does that work?
Yeah, so we consider both, and we look at monthly turnover. So effectively, we just try to break it down to make it easier for business owners. So if you have 500,000 Rand turnover and it's a little bit more lumpy, and we understand that some industries do have turnover which comes in blocks, but then we look at other factors as well, as like in terms of what we're obviously concerned about is that your business doesn't come under undue financial pressure as a result of funding. So we kind of like to work with people to make sure that that's the case. So if you've got 500,000 Rand turnover, we just kind of work that backwards to an equivalent of 40,000 a month. But ultimately, if your turnover is a little bit more lumpy, then we just have to assess it slightly differently. But if you're meeting that minimum requirement, then that's fine.
Great. Thank you, Garth. Thank you so much, everyone, for joining, for taking time out of your schedules. We really hope to see you next week at same time, same place, 11 o'clock on Wednesday next week. Yeah, we've really enjoyed. Thank you so much for all the engagement, all the questions. Please keep them coming. We will share the recording to this webinar. We're going to host it on YouTube and we're going to share it to everyone so everyone will have access to it if they want to look back. But thank you for joining and we hope to see you next week.
Lula.